Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Investing in Dividend Stocks. And today, we're at the end of June. We're going to be doing a 6-month portfolio review. We're just going to get a progress report and see what lessons we may have learned so far in 2026. I think it's going to be an interesting discussion. We're just going to try to show how a self-directed investor might perform a little bit of a portfolio review, make any refinements that they see necessary going forward through the rest of the year. So a lot to cover before we get to any of that, though. Let me first of all say hello to everybody who's chatting in. Great to see all the familiar names. Hello to anybody that might be new. Pardon me, but hello there, Eric, Lawrence, Eva. Who else is here? Is that everybody who's checked in so far? Go, girl. Good to see you. Everybody else, thanks for joining us week after week. We do appreciate your attendance and your contributions to these discussions. If you are among those who are here for the very first time, I want to extend a welcome to you. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us here in the live stream audience. This is a Thursday webcast series, and we kick things off promptly at noon Eastern time. So love to have you here. I also want to let you know that my very good friend Brent Moores is going to be hanging out in the chats with us all the way through the entire presentation. Brent's going to be keeping an eye on any questions that come in. If I can't get to those, Brent's going to be addressing those, kind of picking up my slack for me. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody listening to follow us on social media. You can find your favorite Schwab presenters on X and on LinkedIn. So you can find Brent on X at Brent Moores CS. You can find and follow me on X at Cameron May CS. And you can find and follow me on LinkedIn at linkedin.com/in and then /Cameron May CS. So let's dive into this. And of course, the first thing that we always do is consider the risks associated with trading and investing. Risk is real, so bear these important disclosures in mind. This material is intended for general and informational educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. And any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for the day's discussion. Today is all about looking back and preparing for what may be next. So we're doing our 6-month portfolio review. We're going to be seeing what's been going on with that portfolio. Has it been stacking up against maybe other portfolios out there? We're going to be looking to see, are there any lessons to be taken, any changes that need to be made? And we're ultimately going to plan and place a new position in that example portfolio. So let's go right to it. Let's go to, first of all, as we do each week, let's get some quick market context. We'll look first of all at what's going on with bond yields. Then we'll look at what's going on with dividend stocks. Those two may be sort of competitors in the marketplace for the money of income investing or income-seeking investors. So what's been going on with bond yields? Well, since I left for my Scotland vacation, yields have been coming right on down, and that continues into the present day, and it's been interesting to see a correlation. As there seems to be less and less attractive yields for longer-term income investors, there seems to have been a general move, a migration toward dividend stocks. So watch this. So if you're not familiar with TNX:CGI, this is just a chart of yields on 10-year treasuries. And those yields have been coming down from a high here. How high did we stretch? To about 4.7%, down to today's low of about 4.36%. Yep, that's been coming down. So how has that been potentially impacting dividend stock performance? Let's look at our index for dividend stocks. So this one's a little bit more of a symbol, $SPHYDMUT. The Dividend Monarchs Index Total Returns, Dividend Monarchs Total Returns Index. So this is just showing a group of stocks that have been increasing their dividends consistently over a very long time frame, and seeing how those have been performing as a potential benchmark for dividend investors more broadly. And as yields have been coming up, as yields have been coming down, investment in these dividend stocks has really been moving pretty rapidly higher. That's actually been a pretty interesting correlation to be observing since we launched this webcast series. It's not always an incredibly strong correlation. There's an assumption there, according to traditional economic theory, that if money's not going to fixed income, maybe it's going to equities. But that's really been a strong correlation this year. I want to come back to that a little bit later. But let's go, that's our market backdrop. Let's see what's going on with our portfolio. So as we go into this portfolio review, I want to ask 6 questions. See if we can find the answers to 6 questions. Number one is, how have we done? I think that could be the fun part. It might be the sort of uncomfortable part if it hasn't been a great stretch of 6 months. And this is a review that an investor might perform on a quarterly basis, on a semi-annual basis, or maybe if they're truly long-term, maybe they just take a look at adjustments to their portfolio and take their lessons on an annual basis. But let's go back to that monitor tab. We are managing an example portfolio of $200,000. We're spreading that 5% at a time across a range of up to 20 positions. And so far we have 14. And how are those 14 positions done? Well, let's just go to the bottom line. Right now we're up about 8.75% on that portfolio, not including any dividends collected. Our paper money doesn't reflect the dividends collected because nobody's paying fake dividends to fake accounts. So we can just sort of eyeball that. Our average yield across those 14 positions is about, it's just a shade shy as of this morning, 4%. So I'm going to do a little bit of rounding. We'll call it on average 4%. That is compared to the S&P average of a little bit more than 1%. So a little better than 3 times the average yield is what our portfolio currently is offering. So these positions, since we just started this in 2026, some of these we've been in for 6 months, others we just barely added them to the portfolio. On average, between 3 and 4 months is how long we've been in these positions. So we've collected about a quarter of the year's worth of dividends. So let's say that if we're projecting 4% return on those dividends, maybe we've collected 1% so far. So we might tally that and say our total return overall, we're looking at about 9.75%, right? So that's not doing too badly, right? Our dividend investor in positions that have only been held on average for 3 or 4 months. Historically, are we expecting to get 10% return in that much of a time frame? No, that's more typical of about a year's worth of productivity. That's how good these 3 or 4 months have been. Very likely, significantly driven by what's been happening with yields even just very recently. Now, that's not the only variable, but let's compare that performance to what's going on with a common benchmark for a lot of investors out there, and that is the S&P 500. So let's roll the clock back to the start of 2025. And it looks like we opened right here. Let me just use my trend line tool. We're going to click right at the open for 2020, or start of 2025, 2026. But I'm going to click right there at the open. Let's pull this up to where we are right now. And it looks like our S&P investor is about 7.25%. So if we run the math on that, we're up about 9.75% versus, let's say, an average investor of 7.25%. That's how favorable the markets have been for dividend investors. It's been a pretty good market. We're about 50% ahead of schedule, and interestingly, at a lower volatility level. We've been emphasizing volatility. So that's nice first 6 months. Is that a guarantee that that's what's going to happen in the future? No, we don't know the future. We're not attempting to forecast it, but it is nice to do a little quick portfolio check-in just to know how things are coming along. Now, that's the answer to question number 1. But question number 2 is, did this outperformance as of this moment come at, did we step out? Did we color outside the lines? We have priorities that we've established. This is an example set of priorities for this paper money portfolio. Did we stick to those? Here are those priorities. If you're not familiar with them, let me open my scratch pad. We have 6 true priorities, and then we have a 7th that for some is a point of emphasis. we don't really emphasize in this series, and this is not intended to be an exhaustive list. It's not intended to be the list of priorities, but our first priority, yes, is yield. This is a dividend stock investing series, so we make sure that a dividend is being paid on any stock that we decide to buy. We also have been emphasizing diversification. We have stated a priority that we want consistent payment of dividends. We check debt to make sure that there doesn't appear to be at least that threat to the ongoing payment of a dividend. We have emphasized volatility. We have a preference in this series for lower volatility stocks. We don't want a big roller coaster ride from one dividend payment to the next, preferring stocks that don't tend to move quite as much as others. Now that can come at a cost. It might limit upside. When other stocks are really rocketing up, ours might not go up as rapidly. But the net performance, which is what we just reviewed, is actually a priority in this webcast series. It's not just dividends, but also what is the price of the stock doing? So we look at long-term performance, and we've kind of looked to see, have these stocks historically done well? Not that history is a guarantee of future performance, but we've used that as kind of a general guide. Project says, what's that formula if you want a dividend income for living expenses? I don't know exactly which formula referring to, but if we're making 4% on a $200,000 portfolio, if that remains consistent, which is a question mark, if, that might project to about an $8,000 annual income if those dividends are not reinvested, if they're spent for income, and if those dividends continue to pay at a consistent rate. Now, the seventh priority has been the payment schedule. This isn't something that we've emphasized, so I throw a little asterisk at the end of this because it's not really been a priority for our portfolio, but I still do list it each time. This just means, are these companies paying their dividends all at the same time, or are we kind of spreading that out throughout the year? You know, we haven't really paid much attention to that. We're totally fine. If, let's say, a bunch of stocks pay in January and not so many in February, maybe for that investor, they just need to do a little bit of budgeting to spread that money around. So those are our stated priorities. Let's do a little comparison here as we go back to the Monitor tab. Yield. Have we accomplished at least what do we set out to do? Yes. Yield right now on our portfolio is projected at 4% at the moment. That's multiples of average. Diversification. Have we gotten a little bit excited, bought too much of any given stock? Nope. We have 14 stocks here. What you'll notice is that we do not have any more than 2 in any given sector. And as a matter of fact, as we add to this portfolio today, we're going to be building on, I'll just give it away. We're going to be adding to the industrial sector today. All right. Yeah, Sam, exactly right. I'll get to that in just a moment. Consistency has been an emphasis. I'll show you when we run a scan today how we might look for stocks that are consistently paying dividends. But we have been sure that these are companies with a long track record of paying dividends. Has debt been emphasized? Right here we have a couple of columns that might assist with this. The dividend payout ratio is just really more of a dividend size to the income being delivered by the company. But the long-term debt to capital, we have a column here. Let me minimize this left column here so we can see that. Long-term debt to capital gauges what is how much long-term debt is there to essentially the capitalization of the company in the form of common stock shares, preferred shares, and long-term debt. If we tally up those three and see what percentage of those are basically generating capital for the company in the form of dividend, or pardon me, in the form of debt, high debt may be a threat to ongoing dividends. So we've used that as a filter in our scans. Volatility is something that we discussed last week. I think I'm going to go into that a little bit more today. But Sam says, yep, beta is a gauge of this. What is this beta value? Well, that's basically, think of it as a percentage of volatility compared to the S&P 500. It's not exactly the definition, but I think that's workable. So if we have a company like Target, which was our very first investment, and it has a beta score of 99, you might think that it's about 99% as volatile as the S&P 500 over the last 5 years. Or in other words, if the S&P goes up $1, it typically goes up about $1, maybe 99 cents. Does it do that every single time? Of course not. Doesn't work, doesn't move exactly in step with the S&P. But generally, yeah, as the S&P goes up, it goes up proportionally. As the S&P goes down, it goes down proportionally over time. None of our stocks have greater than average volatility. And actually, our average is coming in at about 70%. So for an investor doing their portfolio review, they might look at this and say, wow, so we're looking at higher than average returns with lower average day-to-day volatility. That is kind of a sweet spot for a lot of investors who are just looking for income. That's how it is right now. Am I going to say at the end of 2026 it's still going to be that way? Nope. But it's nice to be able to see that. What about our other priorities? Performance. Yep. We've made sure to check long term, not day to day, not week to week, but long term, what have companies been doing with share price and dividends? And we'll do that again today. And then finally, the payment schedule. We have that right here. If the investor emphasizes that, we can see when the ex-dividend date is and see if those are all coming at the same time or if they're spread out across different months. Ours tend to bunch together. For some, they just don't care. So have we been following our priorities? Yes, that's an important thing for an investor who's trying to be disciplined. If they're sticking with their priorities, not hopping in and out of stocks in time frames that are shorter than they said. And what you'll notice is in this webcast series, in the whole first 6 months, have we sold anything? Nope. We're not in it for short-term trading. This is an investing webcast series. All right, so those were our priorities. Question number 3 is it time to make any adjustments to those priorities? One thing that we talked about last week is that when we have a very low beta, for example, this beta is a 67, and then the S&P starts to go up, this stock may be slow to respond. Now, if the S&P starts going down, it might also be slow to respond, so that can be a benefit. But what we did last week is we talked about maybe nudging up into buying a little bit higher beta, a little bit more volatile stocks. So for example, last week's investment was IP. If you want to go back, you can check the archive for this discussion, which has a beta closer to a 1-to-1 relationship with the S&P. And actually, it had a pretty good first week, up 5%. That was a nice first week. But it is a stock that's not more volatile than average, but more volatile than the average stock in our portfolio. I think for this portfolio going forward, we may lean a little bit heavier on the beta. We've been fairly conservative on that beta, for better or for worse, because volatility can go up or it can go down. It can expose us to greater upside potential, also greater downside risk. But with our portfolio average beta floating down around 0.7, I think we might nudge that up for the coming year. Not above 1, but maybe closer to 1. All right, so any other adjustments that we might need to make to our priorities? I don't see anything else that really stands out. So the next part of a potentially very important element of a portfolio review is to decide, does any rebalancing need to happen? What is rebalancing? Well, we were careful when we structured this portfolio. With each of these positions, we were careful that it was balanced with the size of every other position. So for each one, we calculate how many shares can $10,000 buy us. That's 5% of a $200,000 portfolio, and then we make that investment. Now, from that point, some stocks that we've invested in will go up in price, and they'll become a bigger portion of our portfolio. From that point, other stocks will go down in price and they'll become a smaller portion, have less of an impact, less of an influence. And so they'll kind of take the portfolio out of balance over time. And Andrew's saying, so Cameron, when do you rebalance a portfolio over a time frame? And that's exactly what we're talking about right now. So here's the rule of thumb that we are using for this series. Not everybody does it this way, but I'll talk about the math of this. Let's look at Target, our very first investment that was purchased. If we click on our shares, bought 100 shares for $108, is about 10,000 bucks. This was back on January 8th. Now, those shares have done well, and they're up 30%. Now, for this series, I'm going to allow a tolerance of growth of up to 60% before we do anything. So think about that. If we invested 5% in this, and just assuming that, that the rest of our portfolio isn't really doing as well, well, that means that Target is getting bigger and bigger in our portfolio. If we go from 5% and we increase that by 60%, what's 60% increase on 5? That's actually taking us from 5% to 8%. Does that make sense? What's 60% of 5? 3. 3% of growth added to our 5% original position takes us to 8, which would be a 60% overall bottom line growth. So bottom line, we're going to be looking at this profit and loss percentage. And as nice as this looks to see big numbers here, to our dividend investor, that might be a caution flag. While this thing is starting to get to be too important, and my portfolio is relying too heavily on just this one security. So if this gets up to 60%, we're cutting that thing back down to 5% of the portfolio, whatever that is at the moment. So that's going to be the plan here for rebalancing. Well, that's if a stock is growing in price. Well, what if it's shrinking in price? We have another one, NEE. We purchased not too long ago. When did we buy? Oh no, we bought this in February. It's been kind of just sort of moving along, not doing as much as everything else. It's down 6%. What's the temptation here? Cut it loose, right? It's not what we're going to do. With our positions, if something shrinks in value, if it's otherwise still qualified, if it's paying the yield, if its beta is still in position, if its debt load hasn't grown too much, all of those things, we're going to add to that position, bring it back to 5% of the portfolio. So we're going to allow this if it slips more than 20% overall. So in other words, if it's gone from 5% within our portfolio to about 4%, going from 5 to 4 is a 20% reduction. We're going to add to that position. So we don't have anything that's gone up 60%. We don't have anything that's gone down 20%. As of right now, I don't see any need, according to those rules, for rebalancing. Now, does that mean we shouldn't sell something? So question number 1 is, how are things performing? Question number 2 is, have we been adhering to our portfolio priorities? Question number 3 is, do we need to update any of those priorities? Question number 4, is there rebalancing needed? Question number 5 is, should we exit any of these positions? What might be reasons for exiting a dividend investment, a long-term investment? Well, it's not going to be, oops, we broke down below an hour-by-hour support level. It's not going to be because some short-term technical indicator says it's time to sell. No, these are longer-term investments. So reason number 1, and these are just example reasons, everybody can have their own reasons, but if a dividend is cut, the purpose here is to invest in dividend stocks that have a long track record of consistent dividend payments. A dividend cut can actually be, in the short term, really pretty rough on shareholders and may be signs of trouble ahead. Might be just shifting priorities or the board directing the company. That's fine, but those don't align with our priorities anymore. So if a dividend is cut, we're cutting it loose. Number 2 is if the stock price has suffered so much that the company has actually done what's called a reverse split. Traditional stock split, we think, oh, the stock price has gone up so much in value that the company is going to call in shares and reissue more shares at lower prices to try to lower the price of the stock. Well, the reverse split is doing the opposite. It's actually calling in those shares and issuing fewer shares at higher prices to kind of artificially prop up those prices, try to get the price up when investors aren't actually driving price up. If there's a reverse split, if that happens to happen, it should be, I don't know the future, should be unusual if we're keeping an eye on this closely. But I've stated those as reasons for exit before, but I'm adding a third exit rule here. We introduce changes to this portfolio management very gradually, but there is a reason we might exit, and that is if the yield itself has come down and stayed down. Now you might think, well, is it coming down because the company's cutting it? No, there's another reason the yield might be coming down. That is because prices just keep going up and up and up and up. Hey, price going up is great for our stock investor, right? But if the price has gone up so far that this is no longer a dividend stock and it's more of a growth company, and the board of directors is not reacting to that by increasing the dividend, we're actually going to turn it loose. Yep, probably very profitably in that scenario. But yeah, a stock price going up and up and up, putting pressure on those yields, we might expect, well, hopefully the company just raises those dividends so the yield goes up. That actually gives us a bigger yield on our initial investment, yield on cost. But if that doesn't happen, we're going to wait 4 quarters. And if here's going to be our benchmark. If our yield drops below the S&P average on a stock for more than a year, done with that. All right. So Mary Burns says, Cam, are we reinvesting the dividends in this portfolio? Mary Burns, I would say conceptually, yes. But within a paper money portfolio, no dividends are actually paid or collected. So there's nothing to be reinvested. It's more of just a concept. So yeah, we're not sort of an investor living off the dividends. We'd be that investor who is using dividends for income, but also for compounding growth. Anyway, so that's a fun portfolio review. What's a final lesson or a final question? We've discussed when we might exit. Final question is, looking back over the last 6 months, the investor might look to see what was the #1 lesson learned from those 6 months. It might be investing mistakes that they're making. It might be they haven't achieved portfolio diversification. I don't know. But I think there's one thing that stood out to me over these last 6 months, and that is going back to this chart. SPHY, DMUT. This is our Dividend Monarchs Total Returns Index. There is a strengthening of the relationship between the 10-year yield and what's happening with dividend stocks in general. This is a really good market condition. What might shift this condition if it seems that yields have been driving dividend stocks higher? Well, if yields start to rise again, if the investor suspects that, let's say, the Fed is going to start to raise rates, if we start to see that sort of a thing, just prepare ourselves that we could see dividend stocks getting a little bit shakier ground. But right now, it's been doing pretty well. But yeah, guys, that is a quick 6-month portfolio review. We still need to add to this portfolio, but just to recap, 6 questions. How's the portfolio doing? Did we stick to our priorities? Do we need to update any of those priorities? Is any rebalancing necessary? Do we need to just sell anything outright? And what's a big lesson that we might take away over the last 6 months? What's something that we've learned to make ourselves more informed investors? So now let's go add to this portfolio. And as I mentioned, one takeaway that I'm going to just implement into this portfolio on an ongoing basis is to maybe nudge that volatility a little bit higher. So let's go put together a scan to look for some dividend stocks that emphasizes volatility to some extent. And I'm going to use why am I not remembering what I called it? I called it the dividend working class. That's it. So let's come up here and run a scan. We're going to load my personal dividend working class scan. So if you don't know what this is, there are a bunch of different categories of dividend stocks. We've talked about dividend aristocrats in the past. We've talked about dividend monarchs. We've talked about dividend kings. And this was designed to look outside of those realms and look for what did everybody else miss, all right? But I'm going to reconfigure this just a little bit. I always like to put a little different flavor on it from week to week and give us something else to think about. First of all, I traditionally have just limited this to S&P 500 companies. Let's open that up. And when I'm done building this, I'll share it with you, all right? But let's say that we're just going to scan in all stocks. Next thing we're going to do is we're going to intersect with a specific group of stocks. So yeah, we're going to look at all stocks, but only stocks meeting specific criteria. So in this case, I'm going to use thinkorswim's public watch lists, and I'm going to intersect our scan with the 25 plus year dividend watch list. So this is literally just looking at companies that have been increasing their dividends over the last 25 years. It's not exactly, you might think, isn't that just the dividend aristocrats? It's not exactly the same. Pretty similar though. But these are going to be companies that have been very consistent with their dividend payments, paying them and increasing them. Next thing I'm going to do is I'm going to exclude a personal watch list that I've constructed that just consists of the stocks that we already own in this portfolio, my current dividend stock positions. So we already have 14 stocks in there. We don't need to see the same stocks again. So that way I know when I see the results down here, I'm not going to accidentally pick a stock that I've already purchased. All right, now a final adjustment I'm going to make. Just to quickly recap how this scan was already built, we're looking for yields between 2% and 6%. We're looking for market capitalization. These are large cap companies, at least $10 billion. So market cap, that's 10,000 million, which is 10 billion. Beta, we've allowed it to go down to as low as 0.5. So about half we've looked for stocks at about half the volatility of the S&P 500. I'm going to dial that up a bit. Let's put on a minimum here of 0.7 to about 50% more volatile, 1.5. Finally, our long-term debt, we have capped at 50% of that long-term debt to capital ratio. So there's our scan. Let me do this. I'll share this scan. Let me pop that into the chat. I'm also, JR asked a good question. JR, I'll get to your question as soon as I've done something else. For those that are watching on the archive, right now I'm going to be adding to my notes this scan that we just built. So I remember if you're in the live session, you didn't capture the scan, or if you're watching on the recording, you can just pop down into the video description. I'll have it down below, and it'll say something like, "Here's my updated dividend working class scan." That's what I'll call it. Okay. So let's run this scan. And as we do, I'm going to let that work for a second. Let me go back to JR's question. How come you're limiting the yield to 6%? So JR is looking at this requirement right here. And I suspected, I noticed this morning my system was having a little bit of an issue. This is having difficulty updating. That's okay. I already know what the scan results are going to be. I always make sure that I'm prepared in case this sort of a thing happens. That's okay. Anyway, why did I limit it to 6%? Well, for some investors, a very high yield, that can look attractive, but it also can be a potential bear flag. A bear flag, getting into technical analysis. Just a red flag. When a company is paying a very high dividend, that means they're paying out a lot of cash on a quarterly basis, maybe on a monthly basis, a lot of outflow from their assets. So where's that cash coming from? Well, it's putting a draw on any income. If the income is sufficient to meet those dividends, if they can't generate the income, they've got to pull from cash reserves. That might not be good. And if neither of those two things are covering that big dividend that they're attempting to pay and not disappoint their shareholders, then they got to go into debt. Each of those things can mean maybe that company is not able to continue to deliver that dividend. So for some investors, they might prefer to not get themselves excited about a very high dividend that may later be cut and cause the income to drop and possibly also the stock price to drop at the same moment. Yeah. There we go. So this is just going to think. I was worried that it might do that. I saw that a little bit earlier today. I'll have to check out my system, see what's going on there. But in any case, I already ran the scan. I want to have a look at, let's go up here, look at my recent symbols. And here are a couple of companies that came from that scan. We have ADP, we have Fastenal, and we have Stanley Black & Decker. Each of these are in the industrials sector. So let's have a look at these. I think what I might do, let's do a comparison. I'm gonna leave it. Let me ask you to give me your input. Which one of these two might we invest in? Let's look at Stanley versus Fastenal. Fastenal has had a pretty good run. If we look over the long term, our long-term investor may not care what's happening on a week-to-week or month-to-month basis. Let's switch this to a 10-year view, and you can see, boy, this stock has done really well. And not only that, it's been paying dividends every quarter and consistently increasing those dividends because that was a requirement of our scan. So if I want to see a chart, not just of what price has done, but also build in the extra value that's been delivered by dividends, we can make a little adjustment to our chart settings. I'm going to go to my chart settings. Let's go to equities, and I'm going to adjust for dividends. I want it to show all dividends. So it's going to combine price increases plus all the dividends, and you'll see our chart shift a little bit here. Before I implement this, just keep your eye here. So here we are at 46.73. Let me draw in a line. It'll make it a little bit easier to reference this. If I draw a line from where we were 10 years ago up to the present day, there's my line. Well, if I add in the dividends, you can see it had to make the price line much steeper. That's all the additional value, or in other words, it had to adjust the 10-year value down lower. That's a ton of additional value that's been added in the form of dividends. So that's Fastenal. Now, Stanley is very different. Let's go up here. Let's look at Stanley. Over the last 10 years, wait a second, it's just flat. Well, most of that is isolated to this right here. You take out this sell-off that Black & Decker had from, what was this? About middle of 2021 until about the latter part, about 18 months toward the end of 2022. That would actually be a nice upward trending long-term chart. Plus, look at what has been happening over the last year, maybe year and a half or so. There are two different views that a long-term investor might take. You have one that's been a grinder upward, and then you have another that may represent more of a value opportunity, starting to show some strength, some return to favor by investors. Neither of these are guaranteed to continue. What do you think? Here's one other consideration. I believe Black & Decker is paying close to 5%, whereas let's flash back here to Fastenal. I believe its yield, as price has gone up, its yield is down in the 2% range. What do you think? Buy the lower the stock that's lower in its range with a higher yield, or buy the stock that's been a stronger performer with a lower yield? That's up to you. What do you think? Chat in SWK or FAST, and we're going to invest in one of those two. And that's going to build out we only have one position in the industrial sector. We're going to be adding some diversification here with a second industrial stock. What do you think? Chat in SWK or FAST. And the first one to get 3 votes is going to carry the investment. Okay, I got one vote. There's a second vote. All right, 3 votes already for FAST. We're going for the stronger growth track record, lower yield. That's the trade-off that we're making. So how many shares can we buy? It looks like we might be able to buy maybe 200 shares, a little bit more. Let's get out our calculator, $10,000 to invest. Let's divide that by 46.72, which is the approximate price right now. 214 shares. So let's make our investment. Click on the ask price. I'm going to buy 214 shares of Fastenal. And I'm going to do that in market price. Now, obviously, price could change as we're placing this order. There's a risk with entering a market order, but it'll give us a stronger chance for a quick fill. There's not a commission on this purchase of 214 shares of Fastenal, but there can be on some types of stocks, or on some types of trades. So let's send this order off, and boom, bought it. Yep, paid a penny more than we projected. But there we go. We are now in another stock in that industrial sector, rounding out our portfolio's diversification. But we've accomplished our 6-month review, answered 6 big questions that an investor might attempt to address as they're looking back over their portfolio, preparing for the next 6 months. So I hope that you'll continue to join me in these webcasts. We'll see how the next 6 months go. But I'm going to let you go. As I do, quick reminder of the educational resources available to you from Schwab. Number 1 is make sure that you're subscribed to our Trader Talks channel on YouTube. You can just go down below the video stream right now, click on the subscribe button. It doesn't cost anything to do that. It only takes a second. But this channel is where you can find webcasts about trading, about investing. That's where this webcast series is parked. So you can join the live streams here. You can find the playlists right here. And as I already demonstrated, if you scroll down through those playlists, you can find my dividend investing. Let's see, did I scroll past it? I probably did. There it is, right toward the top. Investing in dividend stocks. You click on View Full Playlists, and there it is. Now, another suggestion that Brent and I have for you is to follow your favorite Schwab presenters on social media. You can find us on X, you can find us on LinkedIn. It's the place to connect with us in between the live streams. So Brent can be found on X at Brent Moores CS. You can find and follow me on X at Cameron May CS. And if you reply to one of my posts, I just try to reply right back to you. It's really nice to be able to communicate with my audience when the camera is not on. You can also do that on LinkedIn. You just pop over to LinkedIn, go to linkedin.com/in, and then /Cameron May CS is my handle. That'll take you to my profile. Give me a follow here. And if you reply to one of my posts here, again, I just try to reply right back to you. Guys, thanks for giving me your time. Thanks for all the thumbs up. Got over 100 people watching the live stream right now. And as I refresh my screen, 45 have already clicked that thumbs up. That's very much appreciated. That's like a pat on the back to your presenter, but it also gives me a nice boost in the YouTube algorithm. It sends the signal to YouTube that people are enjoying this, and it should be shown to more people, helps more people find my videos. So yeah, click that like button if you enjoy our webcasts. But everybody, I will see you in a future webcast. I'll also look for you on X and on LinkedIn, on social media. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.